In this video, I'm going to share with you 4 huge warning signs that we're headed into a hard landing, recession, and one more stock market crash. Hey, this is the Estate Financial Channel, where we break down financial concepts into quick and simplified bite-sized videos. And in this one, I want to talk about something that's been on a lot of people's minds lately. How big of a problem is the economy? 2022 was filled with negative news that weighed on investments. Everything from the war in Ukraine, the government debt limit crisis, interest rates, inflation, and more. In the last few years, it's become even more important for investors, at times, to be able to ignore the news and their emotions when looking at the economy and their investments. This will help you look unbiasedly at what's happening. That's why this video will focus on data-driven indicators that always show up before we hit a recession. By looking at data, we remove our emotions and biases and other influences, and you just get a summary of the raw facts to make up your own mind. Unfortunately, every single important data point you're about to learn about are flashing big warning signs that we are headed straight into a nasty recession. As you'll see in a moment, these 4 indicators have a very accurate correlation with every major downturn going back decades. Sign number 1. The first major data point indicating an oncoming recession is the LEI report, or Leading Economic Indicator Report. The LEI index measures the overall health of the economy and provides an early warning system for future economic downturns. The reports track 10 major indicators, including things like GDP, industrial production, manufacturing new orders, unemployment claims, construction spending, new housing starts, housing sales, retail sales, consumer spending, inflation, and then weighs them into an index with a score. The LEI report has correctly predicted every recession since 1960. This graph shows each recession with a gray vertical line, and the LEI score with the blue line. Notice also how the LEI turns down sharply before every recession and bottoms at the end. This indicator began forecasting a recession in December 2022, and has continued as of the time of posting this video, in March 2023. This has been worrying many on Wall Street for months now, but gets overlooked in favor of reports directly tied to the Federal Reserve's interest rate policy. You don't have to look further than just the report name though. It's called the Leading Economic Indicator Report, has come out monthly for over 50 years, and is flashing recession. Sign number 2, and this is probably the biggest warning sign. The second indicator is the inverted yield curve. This refers to the yields investors get on U.S. Treasury bonds. Typically, the long-term 10-year Treasury yields are higher than short-term 2-year yields. This makes sense, because with a Treasury you are loaning the government money, and the longer the loan, the more you earn per year. When the yield curve is considered inverted, is when the 2-year yields get higher than the 10 or 30-year yields. This happens because investors are expecting lower returns from longer-term investments due to slower growth in the future. On March 7, 2023, the 2 and 10-year yields marked their biggest inversion since 1981. At the same time, the 2 and 30-year yields set a new all-time record because they were the most inverted ever. So what does this indicator mean? First, it's a predictor of recessions. Every time the yield curve has become inverted this much, it was soon followed by a recession. This just happened on March 7, and since then, the yield inversion has drawn back, meaning it may have bottomed out. Secondly, it indicates the stock market has not bottomed yet. Every single time in U.S. stock market history the yield curve has become this inverted, it happened before the bottom of the stock market. This graph shows the U.S. yield curve in a dark line, with the S&P 500 in the blue line. You can see the S&P 500 stock market index bottoms only after the spike in the inversion to the Treasury yields. Sign number 3. Consumer debt and savings levels are going in the wrong direction. The third huge warning sign, we're headed into a recession, is really the reason every recession happens. A weakening consumer. Once the consumer stops spending, recessions begin very quickly. You may remember the name Michael Burry. He became famous in the movie The Big Short for predicting the mortgage default collapse. Only 2 months ago, he tweeted about the headwinds the consumer is facing. To show you a more complete graph, Look at how much consumer savings has shrunk and consumer loans have increased. This is not sustainable. As Michael Burry says, at what point does this break? Once a recession is really in full swing, consumers begin defaulting on their loans, and the entire financial system is at danger of breaking. We have already seen fallout from banks like Silicon Valley Bank, First Republic Bank, and internationally Credit Suisse, and we haven't even hit the recession yet. All this may have you wondering, why can't this be stopped? Can't the Federal Reserve just hit the button to lower interest rates? That would ease financial conditions, making it easier to borrow money, stimulate the economy, and we're off to the races again. And yes, it can happen like that. Unfortunately, we're currently dealing with our number 4 indicator that's flashing huge warnings we are about to hit a recession. Sign number 4. Inflation, and its effect on interest rates. In 2022, inflation hit 9%, the highest level in almost 40 years. Even at the beginning of 2023, inflation is still around 6%. For the past 60 years, inflation has averaged 2% per year. Any more than this, and it causes big problems for consumers, businesses. The scariest part from the Federal Reserve's perspective is the longer inflation persists, the harder it is to bring back down, sometimes taking almost a decade. Large peaks in inflation have historically been good predictors of recessions. As you can see from the graph, where the dark blue line is inflation, and the yellow vertical lines are recessions, peak inflation happens before and during recessions. To combat this inflation, the Federal Reserve has raised interest rates faster than ever before in 2022. Looking at a graph of inflation on a monthly timeline, you can see it likely has peaked and will begin coming down soon. Specifically, inflation on goods and energy have been coming down, but it is still elevated. Fed Chair Jerome Powell testified before the Senate this month and said the majority of the inflation today is in the services sector, and reiterated it's caused by wage growth, saying the biggest remaining barrier to taming inflation is the shortage of workers. The current unemployment rate in the United States is at a historic low of 3.7%. This is significantly lower than the long-term average of 5.8% since 1948, when records began being kept, and lowest since 1969. This means the cold, hard truth that no one wants to admit on television or in the news is that the Federal Reserve is going to increase the unemployment rate until inflation comes down. They are in the odd position of purposely putting people out of work, and they will continue doing this until inflation comes down closer to 3 to 4%. Maybe even 2.5%. This will further strain the consumer and the banking system, pushing us into a recession. Watch for more regional banks going under, more people out of work, and potentially still high inflation. These 4 data-driven indicators are all pointing towards further downside for the stock market and the overall economy. Nothing is guaranteed, but armed with this knowledge, I hope you are better prepared for any downturns. Remember, knowledge is power. And these short executive summary videos are designed to give you an advantage in under 10 minutes. You now may be wondering, what can I do to protect myself and my investments in the next recession? To find out, make sure to hit the subscribe button and get updated as soon as we release a video on exactly what the best investors are doing today. In this video,